Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, it's time for a look at gold and silver. So we're going to be looking at the CFDs on gold and we're going to be using the SLV as our proxy for silver. And it's time for an update because our primary account has been invalidated. I warned of this several weeks ago that this was a possibility. And the alternate will now become the primary. You have to excuse me sniffling and snuffling a little bit. I'm still suffering with allergies a bit this week, although it's nowhere near as bad as it has been. So, the gold has sold off again recently over the last few days, and the dollar continues to march higher. Now, I just put out a video on the DXY to my patrons where I discuss how we should be looking for a reversal in the dollar. Now, that means today, or next month, or the next 6 months, whatever. We've just broken out into new space. We don't tend to buy breakouts as a rule because they tend to be traps. Not all the time. They can extend further, but they often appear just before a reversal. So we'll be looking for a reversal in the dollar. I have 2 counts in the dollar. One that is very bullish, suggesting that we have just entered a wave 5 extension and it could go considerably higher over the coming months, which is going to continue to apply pressure across multiple markets which are negatively correlated with the dollar, gold being one of them. And then I have a less aggressive count which suggests that the dollar, although still strong for a while, is going to top out and suffer a major reversal at a larger degree. Now, as still part of a larger trend to the upside in the long term, but a significant pullback, multiple month, perhaps even multi-year. So we are going to be on the lookout for that in the coming months. Now, in the meantime, as the dollar remains strong, gold continues to get crushed here. So let's come in and update the count. I'll do that first. Now, the count we were working with was this primary count, which was the idea that this was a triangle, okay, and we'd gone 1, 2, 3, 4, 5 into a 1 out of it. This would have been a larger wave degree, we don't need that anymore, and back into a 2 with a double zigzag here. Now, we've now invalidated that count, so that was wrong, so we're going to delete that. As soon as the chart lets me. God, it's lagging today, it really is. I don't know why that is. I've got a very good internet connection as well. Okay, so that was one idea. The next idea we had was the idea that it was a combination. Let me just try reloading the chart, see if that works. Okay, yes, we've gotten rid of that. Okay, an alternate idea we had was that the chart, that this was a combination count, finishing in a triangle, through a W, X, triangle, Y, into an impulse. This was already invalidated. So that leaves us with the alternate, of which there are 2 interpretations. Now, I've been saying for months now that the alternate is a flat pattern. That hasn't changed. So, quick explanation. We came up into a primary wave 3. We moved down into an A. We moved back into a B to within 90% of the high, actually to within 99% of the previous high. And we're now moving down in what will be 5 waves, like this. 1, 2, 3, 4 and 5 to find our wave 4, with the wave 3 being the most typical extension, and potentially expecting 5 waves down in the 3 like this to extend. Now, it doesn't have to be this aggressive. Okay, if we look at our extensions for our flat patterns, all I've done here with the more aggressive one is aim for a lower target like the 123.6, 130.18 or the 1618. Now, being as we didn't get an expanded pattern, the B did not come back beyond where the A began, we can't call for a truncated C to finish before the A, as we would expect it to have seen the B wave expand. Now, I got a little overexcited in last week's live stream when I thought that was a possibility. Now, the issue was, when I was operating in the line chart at the time, I'd forgotten that this was a lower high, and for a momentarily had considered this to be a higher high, and therefore a running flat was possible. This is not the case. So a regular flat with a 90% retracement is what we're dealing with here. So a one-to-one relationship is perfectly acceptable. So if we were to take one-to-one, we're essentially coming down to test support, right? So we can interpret it slightly differently. We can look at it like this instead. That we've done 1, we've done 2, we've done 3, we've done 4, and now we're in the 5th. So all we need to do with this is make sure that we're not going to end up with a shorter third wave than our 1 or our 5. Okay, because that's a big no-no. So if we take our 1, we can see that the 3 is already longer than the 1, coming to the 123.6, so that is not an issue. Okay, so with an unextended third wave, that leaves room for the 5th wave to extend, right? Rather than share parity with 1, it could come deeper. Okay, and that could easily be enough to bring us back below the wave A here, go slightly beyond 1-to-1, which is typical of the regular flat pattern, and find support perhaps at the base channel I have here, which is long-term base channel off of this primary pivot. We also have support down here at the previous lows. Obviously we tested these 1, 2, 3 times, so we'll be looking for support here. Now we don't know how long it's going to take to get down here. Let's just get that coordinates correct. 7, 8 spots, 5, 8 was that. So we got support here. In the meantime, we would we could just come down to 1-to-1. That's plenty enough. So we could put the 5 here, C, and we could be done in the flat pattern. Okay, A, B, C, and then we can move off. I would expect it to go C to go a little beyond the A, to be honest. So either testing this base channel potentially, breaking support just slightly, and maybe heading for the 123.6 target of an expanded flat. Okay, so now let's have a look at our retracement of the wave 3 thus far. Put into a wave 4 retracement. Okay, we're currently through the 23.6. We're shy of the 38.2, but like I said, we're not expecting it to truncate. Now, there is a rare possibility of a flat truncating like this. Like I said, we would normally expect to see an expansive B wave if this was the case, so I can't rate this as more probable than the likelihood that the C will extend beyond where the A completed as a regular flat. So as you can see, we could be looking for quite a deep retracement. 50% is potentially on the cards here, and that would bring us into this prior base channel, and it would also coincide quite nicely with the 123.6 area of the A wave extension from the B. So best case scenario, we've done 1, 2, 3, 4, and we're now in the 5th wave down, looking to break the lows, or at least sweep the lows for a flat pattern, or we're looking at something more aggressive, and we're looking at 5 waves down, and we've only just gone 1, 2, 1, 2, in which case this could get pretty nasty. Now, in the probability of it coming much deeper, or in the likelihood of it coming much deeper, we have our cut-off point for the idea of the entire count being valid, which is the invalidation point back here at 13.75.15. Break this level, and this was not a 3 into a 4, this was not a wave 4, this was a high, and this is a much more significant correction coming back. Exactly how we would count that, I am at the moment not sure. So I need to go away and work on another alternate count for the worst case scenario, which is the idea. I think the only way we could look at it is that the whole move back to new highs was corrective. Now how on earth we get down from there, I haven't got a clue, because there's no way on God's green earth that this is an impulse wave or a diagonal, not by my counting. So I still see this as corrective, and I see a 99 point something percent retracement as a highly unlikely to, even if this were to be some kind of motive wave. So I am still very much favouring the idea that this is free, and now we are going to get 5, and it could be quite nasty, 5, but it cannot come back beyond 13.75.15. I know that's a long way away, So that's how I see gold at the moment. We've got the base channel here, we've got support here at 1678. Let's see what happens as we approach this level if we find support. Okay, given our technical indicators, we are already very oversold on the day time frame. Okay, very oversold, as we can see here down at the 21.23 level. We have been worse in the past. We've gotten down to as low as 16.29, so we could continue deeper, further into oversold territory. On the weekly chart, we've gotten as low as 16.76, and we're not oversold yet on the weekly. So potential, I think, to maybe some short-term bounce after all of this selling off that we've seen. We've still got to, if we've done 1 2 1 2, we've got to do 1 2 3 4 5 3 4 5 3 4 5 3 4 5, haven't we? As we build up the sub-wave within this third wave, within this third wave, and so on and so on. So still potential. If we do bounce strongly, okay, any move back above this high here, and bear with me, above the wave 2 high here, will invalidate this interpretation. Okay, so we're going to scrub this count if we go back above 1879, spot 4-5, that line makes it. Because it can't be 1 2 1 2 if that's the case. Now, just in case this is 1 2, this is 3, and this is 4, we've already done that. Okay, so this would now be 5 that we're in. I don't see any other real way of invalidating this. Okay, we'll have to wait and see what kind of price action develops in the coming weeks. I suspect, given the acceleration down at the moment, that we might be moving into this 3. So things should progress and continue to accelerate lower. If for any reason we suddenly turn around and get a big bullish candle, then this is the level we want to be watching at 1879.45, because there's no way this count is correct if we come back above that level. Okay, so that's basically how I see gold at the moment. Let's just gather up some of this information here. We're going to put this in with the what will now need to be labelled as the primary, so let's do that. We will now label the regular flat as an alternate. They're both the same idea. I can't at the moment see an alternative to it. Okay, so we're just going to work with that, and I will have to go off and try and find an alternate at some point now. Let's figure out what we've got down here. That's a horizontal ray for support. That's that price label, so let's put those two in there. I'll just say support. I'll switch that off, just doing a little bit of tidying up before we move on. Long range pitchfork. Now this is the corrected pitchfork that I've got here. This is just an original pitchfork based off the A and the B. Let's just turn this into its full form for a moment. I'll turn it into a shift, haven't I? Basic original. So you could argue there's some play between these levels, but it's really not all that convincing. As an original pitchfork, let's put up the full version of it. 23.6, 23.6. It's dodgy. It's not beautifully clear. There is some play between these levels, but it's not absolutely convincing. If we switch it into a shift, instead we can see that these levels play considerably better. Okay. Essentially all we're doing is taking the angle of the A and the B here, so pivot A, B. We can see how the 38.2 has been in play here. The median line was tested here, the median line was tested here, the median line was back tested here, 61.8 was back tested here, 38.2 was back tested here, currently at the 61.8 here. So maybe a shift's a better fit. Now let's just have one more. Let's consider the mod shift slightly lesser angle, isn't it? It's basically going to be the same thing. Very little difference, because the reason there's very little difference between the basic shift and the mod shift is because the disparity between the peak of the beginning of the A and the peak of the B wave is so close it can only adjust by a margin of 1%, which is about literally a fraction of 1%. We come back within previous highs, so I'll leave it as a shift pitchfork for the minute. We'll see if the bottom of the pitchfork offers any kind of support at all. It is a long price support level, so we'll just lock it in place like that and remind ourselves that it is indeed a corrective pitchfork, like so. We've just got a little bit more tidying up to do down here. That's the invalidation point, so let's put this in the long-term count, because that's when the whole count gets invalidated. Okay, lock that in place, save, and then we've just got, what's this here? I didn't put the text in with it, did I? Okay, that's that dealt with. And then we've got this parallel channel on that, and that's the base channel, so let's just label that base channel. Okay, and this here we know is an invalidation point related to the primary. That's right. All tidied up then. So that's gold. So shall we just have one more quick summary, shall we? Primary count now, just focusing on the high, is that we're dealing with a flat pattern, A, B, and 5 waves down in the C. That 5 waves could be deep, like I've got here. This is around the 130.18, but it could come deeper to the 1618. It cannot, however, go beyond 1375.15, otherwise the entire count is invalid. And then the alternative idea is that it is already a 1 and a 2 and a 3 and a 4 done, and we're just in the 5th now, and the 5th is going to extend, not unusual in the commodities market. The 5th of the C is going to extend to take us beyond the A, or to at least sweep these support levels, perhaps this base channel, this support level, bottom of the corrective fork, all these levels we've got below us to keep an eye on, and we're just going to be looking for signs of life. Essentially, we're already very oversold. So on the note of, before we move on the note of negative correlation, as I said, I spoke about it in the recent DXY video, we can see extremely strong, not extremely strong, but we can see strong negative correlation between gold and the dollar. Here, this is the DXY on the CC. So getting as high as minus 0.94, negative 0.94. So negative correlation meaning doing the opposite thing, or doing the opposite thing to the other asset. Dollar's going up lately, gold is going down. They are strongly negatively correlated. So that's gold. Let's now move on, have a quick look at silver, and it's going to be a quick look because I'm still a little iffy on the count. I do have an idea here, and it's the best I've got. So let's just have a look at the charts and from some basic and technical analysis point of view here for the moment. We've got support that could be cut, prior resistance, which now may be getting tested as support. Okay, we can see that we're coming way back into all this market activity here in the volume profile. So there's demand here, here, and here, all through this profile. Right, big point of control here below us. So if we do break this support, come into the thickest part of the trading here, this is likely going to be a deep wave 2, 1 into 2, and then we can begin a huge rally in silver. Same gig as with gold, however, at the moment. If we just bring up our indicators, we can see the strong negative correlation with the DXY again is present here in silver. Slightly weaker than it has been in the past at negative 0.81, but still pretty strong. OBV continues to trend down, very oversold on the daytime frame, and positive divergence in the MACD between the recent lows. So between this low here and this low we currently have, we have positive divergence in the MACD, not so much in the RSI. We don't know it's a low yet for a start, so we've still got a lot to prove here in silver. So now if we have a quick look at our fib retracement, and we just take the low here from March 20 to our orthodox high, not the dominant high. Orthodox high is where our count terminates into a 1, and then all of this is a corrective pile of junk. 2. You can see how we are not far off our 61.8 and 65%, our golden ratio down here. Okay. In fact, I think I've already got that on the chart. Let's just, we don't need that anymore. So here we go. It's 17.21 and 16.64. This is our golden zone down here. Now it's just below the current support that we have at the moment broken through. It's not support unless it operates as support. It's simply just prior resistance now being back tested. So we'll see if it operates as support. Coming into some volume finally, approaching the golden ratio. Okay, filling a couple of gaps on the way down as well, although there are still gaps in the chart to fill. There's one all the way down here as well. So if this is bullish, how are we interpreting it? So let's come in and have a look. The best count I can get on this, for me, that makes sense, is this one. Okay, where we have a zigzag into an X wave. Okay, then we get a diagonal 1, 2, 3, 4, 5 inside of a leading diagonal into an A. We get a W, X, Y double zigzag into a B, and now we've begun 5 waves down in a C. Okay, now once again, dealing with a commodity here, there's the possibility that we're going to get that extended fifth. Okay, so all we need to care about is that the 3 is not the shortest, and there's no way it's the shortest. There's the 1, 2, and here's the 3. So we could be about to go 1, 2, 3, 4, and 5 and get this extended fifth wave down to here to get the C, to get the Z, to get the 2, and then off we go. So deeper retracements. If we were to come deeper, let's just find that dominant, so orthodox high again. We know we've got our golden ratio down here, but we've got the 78.6 and the 89% all the way down here as well if we were to get a really deep retracement. Okay, now that's sorry, I'm clicking on the wrong one. Here you go. So we're either close to being done, right, and that dollar reversal's coming anytime, any day now, and gold and silver are going to find their lows. Okay, or if that rally in the dollar continues to put pressure here, then we can either extend this fifth wave lower, or we can interpret it slightly differently. So let's do that, and let's have a look at slightly different interpretation. And we're just going to turn that off. I'm just going to gather up a couple of things first. Say support and resistance. Okay, turn that off. Get rid of the gaps as well. Get rid of that fixed range. Volume profile. Okay, so an alternative idea is that it's still WX, but it's WXYXZ. Right, now this is more aggressive again. So we still get the W, we still get the X, but now it's A, B, C into Y, W, X, Y into X again, and then it's 1, 2, 3, 4, 5, A, B, and C. Another zigzag taking us lower. Okay, and it's just a big, messy, triple zigzag that's going to bring us down deeper and deeper. And most of the work's going to be done now in this final ABC. I think I prefer the other count here, so I'm going to assign this one primary. Okay, because it still has potential to come down deeper in a fifth wave. Okay, there's our fib levels below us, and as we've seen, oversold on the daytime frame, strong negative correlation still in play with the DXY, positive divergence on the MACD. If we come out to the weekly for a moment, see what we can see. That's a bearish price action. Correlation still, we're in very oversold conditions on the weekly. Not as oversold as we've been, but we've done what I like to call a round trip. Okay, let's just close it off here. Now this is a bit of a phrase which has changed its usage over time for me from when I first started applying the idea, but originally it was the idea that we went from oversold to overbought to oversold, that you've done a round trip. But what I like to look at it now is I like to look at it as the completion of corrections, like larger wave degree corrections, and within a correction being complete, you've gone from overbought all the way to oversold. And that's what we've done here now. So I like to call that a round trip. I know it's not technically a round trip because you have to go back to where you started, but it's just a turn of phrase that I've ended up using and probably bastardising to some degree. But either way, oversold on the weekly. Can get more oversold from here. We've seen that in the past. Okay? But I'm just getting the feeling that we're at some kind of inflection point. We're close to some kind of inflection point in the relationship of all these assets and the relationship of the strengthening dollar. One or two things is going to happen. We are either going to top out soon and there's going to be a huge relief rally across all of these under pressure assets. Whatever fundamental reason you want to subscribe to the technical reasoning of the charts, that's up to you. I can think of half a dozen at least. I can think of one main one, which I'm sure we're all thinking of. But that's beside the point. The alternative is that the dollar's just getting started in what is going to be a pretty aggressive fifth wave extension, and there's still a lot of pain to come in silver, in gold, in equities, in crypto. Alright, so we'll keep looking at the charts and we'll keep looking at it as a technical exercise alone. We'll look for support, we'll look for signs of life, we'll look for a reversal candle in the dollar to the downside and these assets to the upside, and we'll just have to keep paying attention, and when it comes, it comes. Alright then guys, thank you very much for joining me on this technical analysis of gold and silver. If you're new to the channel, you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment section leave us free to a comment in the comment section below. And as always, a huge thank you to my Patreon subscribers. If you're interested in joining the Patreon, there's also a link to it in the description box below. Go over, have a read of the tiers, see if there's anything you're interested in, and feel free to sign up. It is still the early part of the month, so you'll get full value for doing so. Alright guys, thank you very much for joining me, and I'll be back with you soon. All the best. Bye bye.